Good morning, everyone. Welcome to this update for global stocks and commodities for the 4th of February. I guess everyone is aware that there was quite a dramatic sell-off on Friday night, which was the end of a bit of a shaky week anyway, but certainly Friday night really topped it off, and it was a result of really good news. The US economy is going along very nicely. The jobs report demonstrated that. The average hourly rate of earnings or wages increased. So it was all good news, but that caused a lot of people to then immediately start projecting that inflation was going to become a problem and therefore the Federal Reserve would have to raise interest rates more quickly. Now, that may or may not happen because there's a lot of other factors at play here, but anyway, that was the market's assumption. And when the market is as extended as it has been, then it doesn't take very much. Any little catalyst will do, and the computer algorithms kick in, and you get this cascade of selling that we saw on Friday night. Now, there's not enough information to know yet where this is going to go, but we're going to have to make a few assumptions and perhaps adjust our exposures accordingly. So that's what this video is about. It's about looking at what we're dealing with now, what has changed, and perhaps what actions we should take. So let's jump in and have a look. So the agenda is really how traders and investors should be responding to this quite dramatic sell-off. It's the biggest one-day decline in the S&P since the middle of 2016. And my view is that if you're fairly heavily committed to the market, that some money should come off the table. That's just prudent to do that. We'll be looking, of course, at the normal stock and commodity trend update. And for anyone that has not had a look at Market Analyst, then this is what we covered last week. So if you wanted to take advantage of the free trial, then this is what you could have a look at. I certainly did spend some time on market tactics, and I think in light of what's just happened on Friday night, that was really important. Also looked at the merits of ETFs on Japan, a strong local buy in Australia, and so it was a pretty good session. Let's turn now to American stocks and what actually happened overnight. Or on Friday night, I should say. So the biggest fall in 18 months, the index was down 4% across the week, and that's been the biggest weekly decline for a long time, and it's been the biggest decline period for quite some time. We didn't get a 4% decline throughout 2017. So the strong jobs data was the catalyst. The market was primed. It was so extended that anything would have done, and that started the sell-off, and certainly the selling continued throughout the US session, and the market closed right on its lows. So it creates the expectation the Fed's going to have to tighten more quickly. However, we just don't know what the Fed may do because, as I've said many times over the last couple of years, the Fed has put in a lot of hard yards to get the economy and the stock market to where it is. They're not going to want to unstitch that too readily by raising interest rates too quickly. The situation gets clouded a little bit because the Fed meeting that occurred through the week was the last for Janet Yellen, and we know what her approach to things were, and we now have a new Fed chairman. So that's a bit of an unknown as well. But my view is, given the chart pattern that we saw, the selling that we saw, there's almost certainly more to come. Now, I know that we've had this situation numerous times over the last 2 years where the market has sold off, but a couple of points. The market was never as extended as this one was, and that is a multi-decade extension above the mean. And secondly, there hasn't been a fall as sharp as the one that we've had. We haven't had a 4% weekly fall. So I think those two things together, you have to assume that there is almost certainly more to come yet. Whether it's a little bit or a more significant amount is yet to be determined. We need more information on that. So from my perspective, this is the order in which you should be thinking. First of all, lock in profit, protect capital. That's the first thing that you should be doing. Forget about making profit from trades in the very, very short term, in either the next few days or possibly week or two. This is all about getting yourself to a position where you can protect what you've got. Secondly, and much afterwards, would be to look at profit taking or profit making opportunities. So that is secondary at this point in time. Now, just on the currency, the US dollar, which had been oversold, did turn up from oversold, a little bit of safe haven to it, but it's really still below the broken support level. So it hasn't exactly thrown in a massive reversal yet, as we will see. So let's jump into the charts. Now I want to start with the S&P, and this is a very big picture. So this is S&P on a monthly candle basis. So these lows right back here are 2009. So you're looking at about 9 years worth of market action. And you can see just how far above the moving averages that even the monthly chart had got. This is the 10-month moving average. You can see over here, we really only got just a little way above it, but here we were massively above that 10-month moving average, and we're well and truly overbought. So you can see just how far down the market would need to come to just get back to this first moving average. You know, that gets you down under 2,600 points. Let's look now at the daily. You can see quite a sharp move. So the extension above the mean, I covered this last week. I can't find another time in the last 30 years when the market was extended above the mean as much as this one. And there's not been a single session fall of this dimension in all that time as well. Or certainly in the last couple of years, I should say. Now, there is still room to go to come down to the 50-day. Now, we've become acclimatized to the market only coming back to the 50-day moving average. But if we pan back and take a bigger look, you can see that it's quite normal for the market to come back and test the red 200-day moving average line. In fact, possibly even going below it, as it did in late 2015 and early 2016. So at this stage, my thinking is that we're probably going to come back at least to about here, mid 2600s, which is another 100 points on the S&P, and we could easily get back to 2500 or just a tick under it. I don't really want to explore any more on support levels because I just don't have enough information at this point in time. We have to be guided by the market. But I would expect there's going to be another 100 points, possibly another 200 points, 250 points come out of this market yet. Now, whether that happens very quickly or happens slowly, again, we don't know that. So we just need to step back, protect, and then once the market has given us more of an indication of how traders are seeing things, then then we can take it from there. So that's the S&P. Let's just look at the NASDAQ. So we'll look at the QQQ. The NASDAQ fell by around about the same amount as the S&P. So there wasn't a particularly significant panic in the more volatile stocks, which the NASDAQ often tends to be. But you can see same extension above the mean and the same quite dramatic pullback. But both of those indices were down around 2% on Friday night. If we look at the Russell, this is the Russell 2000. Similar sort of decline, wasn't as extended above the mean, so we don't have necessarily as much work to do on the downside. And it's how the small caps behave that will be a key indicator for me. Now let's look at the VIX index, because the VIX index spiked up quite sharply. So you can see we've been down around this 8, 9, 10 area on the VXO for a long period of time. The odd little excursion got up to the 13s very briefly, but this time we've gone up and almost touched 18. So this has been the most significant blip in the volatility that we've seen since October of 2016. So that's about 16, 17 months. So this is significant. Now, the final thing I want to look at with the US is the US dollar index. So we've broken some key support levels. We broke obviously this level here, this inclined level, this one here. The market had got, or the index had got quite oversold. We got a bit of a turnaround, but it wasn't anything overly dramatic on the US dollar. So I don't see this necessarily as proof that the US dollar is suddenly going to get stronger. Now, the impact on the Australian dollar has been to drag us down. We were above 81 on Wednesday, and we finished at 79.3 on Friday night. So it'll just follow along, get tossed around in the storm with the other major currencies. Turning now to Aussie stocks, the Aussie dollar fell, as I said, to 79.3, and the ASX gained 71 points on the week, but you can rest assured that will disappear on Monday for sure and certain. And then where it goes from there will depend a lot on global equities. So if we just look at the XJO quickly, so quite a good finish on the week, but expect that to all disappear on Monday. Precious metals now, gold was down sharply by $19 to $13.31, and if you look at the relative contributions, roughly half of it was due to the currency move, and roughly half of it was selling, liquidation selling, which often happens with precious metals when there's a sharp move in equities, because many players in the equities market are so leveraged that they just start selling other things, and precious metals often is quite a leveraged area as well. So it was partly liquidation to cover losses elsewhere. Now, precious metal stocks, I've been warning that the small gains that we saw in the GDX would not leading the actual gold price higher, and therefore were at risk, and would therefore disappear when the US dollar turned, and that's exactly what happened on Friday night. So let's take a look at that. There is gold on a weekly chart, so a bigger picture view. So not a particularly dramatic move in the price of gold. This is it on the daily. But it's really GDX that I pay more attention to, because that does tend to lead, and you can see we've turned back down again in GDX. So still nothing doing there in terms of sustained momentum. Elsewhere, copper held up pretty well, considering. Only dropped a fraction to 3.18, and certainly did better than the actual currency itself. And that's really a reflection of the fact that the supply and demand around copper is still quite favourable for higher prices. Now, West Texas Intermediate crude did ease back to 65.5, but again, not that much. But stocks took a lot more of a beating than the actual crude oil price did itself. And that suggests to me that the run that we've seen in energy is probably concluded for a little while. I think we're now going to get a consolidation phase that could run for quite a few weeks, or possibly several months. So I wouldn't be expecting too much from that sector at the moment. Here's the spot copper chart. So it's just been hanging around this $3.20 area for some time. And there's the crude oil chart. Didn't really respond that much despite the higher US dollar. So to wrap it up, most traders, if you're a shorter to medium term trader, you really need to cut back, because there's a chance that this market will not advance now for multiple weeks, and quite possibly several months. And so therefore you really should reduce your exposure. Hopefully you've already done that in prior weeks, as I've been talking about. This was quite a dramatic move, so you've just got to expect more to come yet. Now, the fundamentals around the market and the valuation around particular stocks can mean absolutely zero when you get a bit of a cascade decline. Now, I'm not saying that that's what's going to happen, but I really just don't trust the computer algorithms. I don't trust what traders will do that have got a huge amount of profit in a short period of time. And I think it's better to take a very conservative approach at the moment. Now, if you're an investor longer term, you've got a bit more latitude as long as your psychology is okay to ride out whatever the market throws at us over the next few months. But you still need to consider your position. The worst thing that you can do is to decide to do nothing at the moment and wait and see. And then if the market falls heavily, then you sell out. If you're going to sell out, then do it now, because selling out when you wait and see is generally selling near towards the bottom of the decline. And then you hit with a loss, and then it's difficult to get back in again. So consider the amount of exposure that you're comfortable going through over the next couple of months and take action accordingly, but do it now. Now, portfolio analyst this week, I'm, amongst other things, I'm going to be looking at stocks that are best suited to a correction. I think that's the most appropriate thing to be looking at the moment. So a pretty abrupt jolt from Friday night. We need more information. The market may bounce a little on Monday. Hopefully it does, which then gives people an opportunity to get out at reasonable prices. But I think by this time next week we'll have a much better fix on what the market is doing. So that's it for this week.